Nothing I share here is financial advice. This is all based on my own experience, my strategy, and how I see the market. You're responsible for your own trades, so always do your own research, manage your risk, and never trade money you can't afford to lose. This content is meant to help you learn and think for yourself, not to copy or follow blindly. Let's keep it educational and intentional. Hello, traders, and welcome back. Let's take a look at a few charts. First of all, we're looking at the sell model. We looked at this chart some time ago, actually in a video from about 2 months ago. Back then, we were watching this sell model, and the level price was hitting, which was the production cost, along with a few other indicators that were signaling a possible bottom formation. At the same time, we also had the scenario where price would continue following the usual bear market drawdown model and potentially make new lows. Now, as time has moved forward, we can clearly see that this lower model is no longer looking very strong. Of course, everything is still possible, and the lower levels haven't disappeared. But as things stand right now, price is clearly not breaking down from the range the way many people expected. Instead, this has currently broken to the upside. And of course, personally, I would actually be happy to see lower prices. Don't get me wrong. I'd probably be even happier than many of the people calling for lower prices, but who are too scared to actually buy them. I would absolutely love to buy lower. But the reality is, that's not what the data was telling us at that point. There were multiple signals pointing toward a bounce. For myself, I didn't miss that. I updated clearly that I was buying spot and looking for leverage trades, which we ultimately did. The one thing I still don't fully like is the time factor. Because of that timing factor, I am still open to the possibility of a longer range. And that's something I also mentioned in older videos. That range could look something like this. Price bouncing here, then retesting these lower areas later, but not making significant new lows, or maybe even forming a higher low if we get lucky. If we get even luckier, then yes, maybe price makes another low and I get to buy more. But I'm also perfectly fine buying inside a range. So right now, what we have is essentially two main possibilities. Scenario 1. This is a large fake out, and we still eventually get the full 80% drawdown similar to previous bear markets. Scenario 2. Price is actually holding these historical data areas, and even if we retest them later, we don't make a meaningful new low or no significant new low on closing basis. And that's exactly what we continue to observe. As you can see, these historical data areas are rising over time. So with each passing day, those levels slowly move higher. That means at some point, even if price revisits this area, it becomes more and more likely that it would form a higher low instead of a lower low. But for that to happen, this current rally would first need to fail. And right now, we don't have that. So yes, we can think ahead, plan scenarios, and prepare ourselves. But at the end of the day, price action has to confirm it. For now, we have a rally, and what we need to see is where it actually stops. With that said, let's switch to the next charts. Next, we have the 5-day EMA setup. This setup really makes things simple. As long as price remains above the EMA, there honestly isn't much technical analysis needed. It gives us a very straightforward bias. All major 5-day 5 EMA setups have historically led to bigger moves sooner or later. In other words, no major move happens without this setup being active. That's partly just due to time, because eventually price crosses it and activates the setup. So as long as price is above the EMA, we continue looking for higher prices until that changes. Now, most setups do eventually fail. You can clearly see that. But I don't trade purely based on this setup alone. I mainly use it as a directional bias for the period where price remains above the EMA. Historically, we also have some useful stats. Failed setups usually last around 2 bars. Winning setups average around 10 bars. And we've already clearly passed that early failure window. That means, unless price closes back below the EMA, this setup remains active. If price does close below, then the setup either becomes invalidated or simply closes out in profit, and we wait for the next one. Right now, this EMA is sitting around 75.6K, and it's rising. So that's the key level to watch over the next 3 days. Can price hold above it or not? Wicks below are perfectly fine. All we really care about is the close. So 9 is 75.6K equals key level. Daily 5-day close above equals bullish bias remains. Close below, reassess. We'll come back to this chart in about 3 days, but for now, keep that 75.6K number in mind. Next, we'll look at a few other EMA setups. And yes, I know we've been talking a lot about EMA setups lately, but that's simply because on higher timeframes, they don't trigger very often. So whenever they do, they become important. The last major ones were bearish setups back near the highs, and I remember we talked about those too. As you can see, after that, price had no major setup on the way down, and now again, we're seeing some crosses. That's why I mentioned them. Now let's look at the EMA crosses and a few targets. This concept also works on lower time frames, but on higher time frames, the hit rate is much better, and that's what really matters for us. Why? Because hit rate gives us numbers, and those numbers represent probabilities based on historical data. Of course, that doesn't mean they can't change. They absolutely can. But what it does mean is there is a statistical probability that the setup plays out and a probability that it fails. And by trading the higher probability scenario, it doesn't mean you'll always be right. But more often than not, you should be on the correct side. Now in this case, we have the setup on the 3-day time frame. The rule is simple. When the 5 EMA crosses above the 21 EMA, while both are still below the 55 EMA, then the target becomes the 55 EMA. On the 3-day time frame, this setup has an 88% hit rate. That means 88% success, 12% failure. When it failed, we usually saw either a longer sideways period or a retrace without significant new lows. For example, price could simply retest mid-range, form a higher low, and still remain bullish, because technically on the 3-day time frame, price has already made a new higher high. That means price could retrace 50% of the move or even deeper and still remain in a local uptrend by forming a higher low or even an SFP of the low. So for now, the 3-day setup remains active. Now, if we switch to the 4-day time frame, we can see that the EMA cross has also happened there. And here, the historical accuracy is even better, 91.7% hit rate. So, more setups are accurate. 11 out of 12 times, price reached the target. Only 1 out of 12 times it failed. That means, statistically speaking, it has a very high chance of reaching the target. And only if it fails this time do we then adjust those probabilities downward for future setups. For now, 4-day setup active, target around 83K. Then on the right side, we have the CME chart. Here we have a very similar setup. CME doesn't have as much history as the index chart, so we can't compare full cycle history. But based on the setups we do have, price always reached the target. So CME setup remains active. It only invalidates if we get a bearish cross back down. That bearish cross would happen if price closes below roughly 75K in the next 2 days. If that doesn't happen, target remains around 84K plus. Again, depending on where the EMA is at that point. That would imply roughly another 8% move higher. So now we have 2 key numbers to watch. 75.6K 5-day setup, 75K CME setup, and of course, 71K 4-day setup invalidation. But for now, the 71K level is less relevant because the 75K area would be the first major warning signal. So the key number to remember right now is 75K. And we'll take that into the next chart as well to see whether we have more confluence around that zone. Next chart is the yearly fib time and price chart. Here, we're mainly looking at price in relation to time, especially when price reaches key time windows. Previously, we were watching these lower time areas and using them not only for potential bottoms, but also for directional bias. If you remember, we were talking about this resistance area and the time window where a breakout would ideally happen. And that's exactly what happened. Price moved into the time window. Breakout occurred, Now, if that breakout had failed, then we would simply maintain a range bias and look for sideways movement into the next yearly fib time. But if price breaks above, then we look for higher prices into the next major time area. Now, the other key thing we're watching is the FOMC event, which will be this Wednesday. So these are the 2 major time windows I'm focused on. FOMC, yearly fib time. And because FOMC is very close to the yearly fib timing, what matters most is where price is when we hit those dates. Of course, it can get tricky. For example, price could move down first, then rise into FOMC, then drop again into yearly fib time. So yes, this could absolutely become complex. For me personally, I would prefer to see price hit important price levels exactly as it enters those time windows, ideally near higher timeframe support or resistance. For now, the most important local level for the current move is the last daily swing low. As long as price remains above that, it can retrace, form a higher low, and that's where I would look for the next trade. So realistically, the 75K to 73K area is the key support zone we want to hold for the current daily uptrend. And if that area gets hit around yearly fib time, then I will absolutely be looking for setups there. Higher low, SFP, support reaction. And if that fails, then of course we look lower again. Now let's talk scenarios. Scenario 1. Price moves down into the event, then rises, then drops again. This is possible because we actually have two fib timing zones close together. Scenario 2. Price holds here or rises into the time window first, then drops into support later. That would still fit nicely with daily cycle timing, yearly fib timing, higher low formation. So again, this is all about level-to-level movement combined with time confluence. That's what we're looking for. And because of that, there really isn't much reason for larger trades until one of these major time windows gets hit. That's exactly why I like using them. They help avoid unnecessary trades and focus on key opportunities. Now, on this chart, we also have trend lines. These trend lines are based on both time and price. At the moment, price is trading between horizontal resistance and a time-based trend line. So this creates a zone where price could simply chop around until time runs out and a larger move happens. And importantly, that move doesn't necessarily happen because of news. News can absolutely act as a catalyst and create volatility, but it usually doesn't decide the direction. In most cases, the move is already pre-positioned and the news simply accelerates it. For example, with FOMC, we often see a reaction before the event and then another reaction at the event itself. Historically, rise into FOMC, often rejection, drop into FOMC, often bounce. You can clearly see this in previous examples. Is it perfect? No, but it's still very useful. There are, of course, rare cases where we see no reaction at all, usually during major breakout periods. But more often than not, we do get some sort of retrace around these dates. That means a lot of the current move may already be pricing in the bearish event beforehand. So now, I'm mainly watching how these dates align with yearly fib timing, where price is at that moment, and what type of setup forms there. Yes, there are a lot of lines on the chart, but each one serves a purpose to help identify where time and price may align for the next major move. Okay, so here I've marked out the time window we are currently in. And if we look back at previous examples around FOMC, we can see a few recurring patterns. For example, we had situations where price rose into that time window, then dropped. And that drop basically lasted until the next FOMC event. Overall, that created a longer sideways phase with its own ups and downs before finally breaking out. Then we had another FOMC event where price simply moved sideways and then higher. So yes, sideways and up is absolutely possible, but it happens more rarely, and we can't really expect it unless price actually confirms it. On the chart, that would simply mean higher highs, higher lows, no major breakdowns. Then in another example, we saw a drop into FOMC, immediate rise, then another retrace, followed by continuation higher into the next fib time element. That's exactly what I mentioned before. This can get tricky, but even when it becomes complex, the timing itself remains very useful, because even in these messy periods, we still often see reversals around these fib time windows. For example, one move ended right at that time window, but then ranged afterward. So one thing I'm noticing is when price chooses a direction inside these time windows, it often continues in that chosen direction. Sometimes range first, then move. Other times, direct move. Then in the most recent example, we had another FOMC event where price ranged, then dropped into the date. And that actually formed the bottom, after which price rallied into the next fib time. So in that case, no reversal exactly at FOMC. But with yearly fib confluence, it formed the low SCO, and then price continued until the next major timing area. That brings us to where we are now. So yes, in most cases, we do see some type of reversal around FOMC, but when yearly fib time is also involved, things can become more complex. Because of that, I'm personally placing more weight on the yearly fib timing in this case. However, if we do get a drop into both FOMC and yearly fib time together, then I would absolutely be looking for a trade. Now, if we use previous fib time fractals, we can get a better idea of what types of scenarios are possible here. So let's use those fractals to map out a few potential paths. First scenario, we see price chopping around in this area, not making significant new highs or lows. This would basically mean price is simply spending more time sideways, which honestly is not a bad thing. In fact, the more time passes without price making new lows, the better that usually is for higher prices over time. So in this scenario, price chops around, maybe tests lower levels, maybe not, but overall remains range-bound. Of course, it won't look exactly the same as previous fractals, but the key point is the behavior. No major breakdown, no breakout, just sideways. And if we see something like that, then our bias needs to shift toward expecting more range, not expecting too much too soon. As long as the low is not lost and the high is not broken, then we should mainly expect sideways movement. From there, the focus becomes local trades, smaller opportunities, or even simply reducing manual trading. Meaning, if I don't personally have a strong setup, then I simply wait or look for signals from other strategies instead. So that's the first scenario. A longer sideways phase, not necessarily exciting, but structurally still constructive. The second scenario is that we get some chop here first. In other words, they don't make it easy. And that would likely mean we see a drop first. At that point, many people would probably start turning bearish because they'll naturally compare it to the previous range where we also saw a drop. But the key thing is, these two ranges are different. They are different structurally, and they are also different in terms of timing. However, most people won't really care about that. They'll simply assume it's the same pattern repeating. So what could actually happen is, price drops, fear increases, people turn bearish, but instead of breaking down, price simply forms a higher low, and from there, we rise into the next major higher time frame level, mainly the next major price area on the yearly fib and price chart. This would actually be a very strong level. As we've seen before, that area previously acted as support during the last range. So if price reaches that zone again around yearly fib timing, that becomes very strong confluence. Of course, it won't look exactly like this fractal. It never does. But the broader idea is local drop, higher low, rise into resistance, potential rejection there. Maybe after that, range, chop, or another setup. But that part matters less because the real focus would be trading the level itself. Meaning, if I have a setup at that higher level with clear invalidation above it, then I don't really care too much about smaller price movements beforehand, as long as price hasn't already broken significantly higher. That could actually become a very strong trade. And honestly, I think I would likely take that trade directly if those levels are hit. Not fully confirmed yet, but the plan is clearly developing. Now, what makes this tricky is the emotional part. If we do get that drop, that lower area is exactly where emotions would likely peak. That's where fear rises, bearish sentiment increases, people panic, and that's often exactly where support may actually be forming. So if that happens, we need to be ready to look for setups, not emotions. Whether it's immediate reversal, longer chop, or delayed move higher, we don't know yet. But structurally, that zone would clearly be major support and therefore an important area to watch for opportunity. So in this scenario, we would basically see price range a bit more. Yes, maybe we get some new local move down, but overall price holds this area. What that would likely look like is price chopping between the time trend line and the local resistance. Then eventually break higher, move into the next resistance zone, which would align very nicely with the yearly fib time. At that point, we could then see pause, rejection, or larger range formation. And from there, we would reassess what the second half of the year may bring. Because if price spends more time sideways in this lower area, then that would move us closer to the broader 4-year cycle low timing, which would generally make me more interested in longs. But for now, that's too far ahead. Right now, we want to focus on the current move. So this scenario is essentially no major reversal yet, more chop, slow movement into next month, rise into resistance, then potentially a month of sideways price action afterward. And importantly, all major scenarios still generally point toward the mid 80K to 85K area. Of course, wicks beyond that are always possible. But structurally, that zone remains a very important price level where I would absolutely be looking for trades if price reaches it at the right timing. And for now, the EMA setups are also aligning with that region. As long as Bitcoin does not lose key support or breaks higher first, then this remains valid. Now the bearish scenario would be price loses this support area, loses local structure, and starts moving lower. In that case, I would first look back toward mid-range, then reassess from there. The key is simply being prepared. Now the bullish breakout scenario would look like this. Price forms a higher low, then pushes above resistance. At that point, shorts would likely get stopped out, resistance could flip into support, and I would likely look for another long there. Then, trade it higher toward the next major resistance zones. So as you can see, everything remains step by step, either down or up. It honestly doesn't matter too much, as long as we continue following the setups, the data, the levels. Right now, the data is still pointing higher. But I'm open to both, longs, shorts. This range has actually provided very nice trades due to all the confluences involved, and I plan to keep using that same structured approach, even if we occasionally get some failed trades here and there. For now, I'm mainly waiting patiently for the next major time area. And yes, maybe I miss a move or two, but that's fine, as long as I follow the plan, the scenarios, and trade level to level. With that said, let's switch to the next chart. Here we have the weekly time frame, our 202-day cycle, and the key weekly SR level. Now, price has officially closed above the range. Last week we had an SFP. This time, price actually closed above it. For me, that means price has found acceptance back inside this value area. And technically, that would mean we now aim for the point of control of this range, unless price breaks back down from here. Now, for that bearish scenario to happen, we would basically need a large red weekly candle closing back inside the previous ranges. That would obviously be bearish, and from there, testing lower levels would absolutely become possible. But for now, this area is potentially support. Meaning, if price comes back to retest this level, I would personally look for longs. And as long as price remains above this area, I'm aiming higher toward the next major SR levels. Around 82K, around 93K, with the point of control sitting around 88K. Now, to be fair, I do think the 82K, 85K region could already act as strong resistance. So once price gets there, we'll obviously need to watch local structure more closely. But for now, on the weekly time frame, the bias remains simple. Price reclaimed resistance, bias is higher. Now this becomes even clearer when we look at the CME chart. Here, we were already watching this breakout 2 weeks ago. Why? Because CME had already closed above this level while some other exchanges had not. And CME is especially important when it comes to closing base analysis. Last time price closed a weekly candle above this area, we saw a very strong rally. Now once again, weekly close above, new local high. And technically, as long as this area holds, the next major level is higher. That next weekly SR level is around 90K. Although personally, I think the lower resistance region around 85K could already provide reaction. The larger SR level, however, is probably closer to 95K, 100K. If that zone eventually gets reclaimed, then we're likely looking at the higher range being targeted. But for now, that's still a bit early. Our current focus remains this reclaimed weekly level, whether it holds as support, whether price stays above, or breaks back below. That's what matters most right now. With that said, let's switch to the local range and the levels we currently have there. Here we had the range, which for now has broken out. Price is currently retesting the 4-hour SR level and the daily order block. Right now, we're not seeing any major move above or below yet. Once price breaks higher, the next major area to test would be the daily structure. That daily structure still remains bearish as long as price is below the daily swing low. That's the main higher time frame structure. And of course, that structure has its own levels, where price could form a lower high, SFP the high, and still remain bearish. That would mainly be around 85K and the 90K area itself. So once again, this aligns nicely with our yearly fib timing zones. Now, for the current move, we mainly want to see where new positions may become interesting. First, the daily local trend is currently up. It's not the major structure, but it is still a valid intrastructure uptrend. So here, The last higher low is the key area. That doesn't mean lower support disappears, but for this move to remain bullish in a simple and clean way, we need this low to hold. That means retests are fine, SFPs are fine. But if price starts closing below this level, then focus shifts toward the next support area. And at that point, this current support zone could then flip into resistance. So this is where bias would already begin to weaken a bit because it opens the door for more downside. For now, price is above, trend is up. If that changes, then we adjust. But until then, this remains the preferred support zone for continuation higher or sideways. Now, I've also marked out the next daily cycle low time window and the mid-daily cycle. What I'm mainly watching here is, can price make a new high after the mid-cycle time window? If yes, bullish continuation remains likely. If no, then we may expect more sideways movement or a potential lower high into the next timing zone. So, price action needs to confirm weakness first. Until then, even if price doesn't immediately make a new high, it can still simply chop around. So the main scenarios are: Scenario 1, low holds, high remains untouched, sideways continuation. Scenario 2, price makes a new high after mid-cycle. Then we look for higher prices, followed by a retrace, then ideally another higher low. Personally, I would actually prefer to see a choppy move upward that still makes a new high. That would fit nicely with mid-cycle timing, yearly fib timing. And from there, we already know the larger scenarios: breakout and hold, or rejection and retrace. Now, from that higher zone, a retrace would make sense not only because of yearly fib timing, but also because of the daily cycle low window. That could create volatility down, higher low, continuation later. Now, over time, a larger dominant cycle may eventually take over. So yes, a move higher into resistance could absolutely become longer retrace, bigger range, extended consolidation. That's why we continuously observe levels, tools, cycle timing, and data points to maintain proper bias. For example, as long as price is above support, I cannot justify being bearish. And similarly, if price reaches resistance, I can still aim for higher until resistance actually proves itself. Only once we see rejection, failed breakout, or support loss do we meaningfully shift bias. So yes, if we get another push higher, there are valid thoughts about retrace or longer sideways movement afterward. But until that is confirmed, the current local trend remains up, and if this key support level breaks, then we shift bias or wait for more clarity. Until then, support remains support. With that said, let's switch to the new indicator. This indicator will soon have a strategy available, and if you want to trade it, you can use the code WHITERABBIT for a 25% discount on Crown's webpage. Or simply DM me. They will be increasing the price by the end of the week once the strategy is officially released, and everyone who buys it before then will get the strategy included for free as an extra. So if you're interested, make sure to get it before the price increase. Of course, you can also simply join my Patreon, where I'll be trading all setups live anyway and sharing exactly when I take trades. That way, you can save money on tools and instead just follow my account, where I share all strategy entries, my personal trade executions, additional strategies, and several extra resources. So with that said, let's look at what this indicator is currently showing. Last week, we were watching whether price could hold this low. The idea was simple: hold support, look for higher prices. And that's exactly what happened. Price retested the area and made a new high. Now, our own SR level is slightly lower. For me personally, the first real sign of weakness would be price losing the last higher low. On this indicator, the support level has shifted slightly higher. So now, we basically do not want to see price losing yesterday's low. For now, this area remains support until proven otherwise. If we start seeing daily candle closes below this level, then the door opens for lower retests. And in that case, the lower support zones become the next levels of interest. So this indicator is useful for a few things here. First, the local level is currently support. I don't yet know if I'll get a direct setup here. We'll evaluate that soon. But structurally, this is the first support zone. If it gets lost, focus shifts lower, lower support zones become more relevant, and local downside opens up. At that point, I would likely expect lower prices first into stronger SR levels before reassessing, meaning I would simply wait for the next level to be reached and then form a new plan from there. For now, Local support holds. Wicks down are perfectly fine. No real weakness yet, at least based on this chart. So for now, support remains support, and we'll continue updating this daily. In Telegram, I usually post updates every weekday anyway. Now let's mark out a few new local levels and see what we currently have. First of all, let's check momentum. 2-week time frame momentum is up, and for the first time, it now has the chance to reclaim the lower band, as long as price closes above 65K. By the way, this is a new 2-week candle, and price often forms order blocks before larger moves. So if price forms a 2-week order block here, that could mean lower time frame chop for the next few weeks. That would actually make sense. Sideways movement, local retraces, then continuation later. A lower retest would be perfectly fine. But if continuation doesn't happen immediately, then yes. A few weeks of sideways movement would absolutely be possible. That would also align nicely with next yearly fib time, new monthly open. We'll check the full statistics again on Friday. Weekly time frame. Weekly momentum remains up as long as Bitcoin closes above 63K. Last week, that level was around 68K, so it actually moved lower, which is bullish. This also means price technically has room to retest the 63K area. Now, if that happens, weakness would become visible, mid-range retests become possible, but it could still simply form a bullish higher low. For now, though, that is not the case. As long as price is above the current SR level, bias remains higher, 3-day time frame. Momentum is in the bullish control zone and remains up as long as Bitcoin stays above 73K. This is our local key area. A wick down into the range order block is completely acceptable. 2-day time frame. Now this is where things start getting a bit trickier. Momentum is high, but that alone isn't bearish. It can stay elevated for quite some time. What matters more is the last SR level holding. This final 2-day order block is a level I would absolutely be interested in if price comes down. So, SFP into it, bullish opportunity, small deviation, acceptable, level loss, potential short. This is an important zone. Now, we also have a candle formation developing here. If this 2-day candle closes below the local SR level, that opens the door for a move lower into the 2-day order block. Personally, I'm not overly interested in shorting that local bearish setup yet. I'm still more interested in longs. So if price drops, I'd rather wait for the lower level. If we don't get it, then I simply let existing runners continue. Daily time frame. Daily momentum remains in the bullish control zone, and this is exactly why many traders who short overbought conditions get destroyed. Momentum can stay strong far longer than people expect. Strength is not weakness. For daily momentum to truly cross down, price would need to close below roughly 78K. Personally, if price closes below yesterday's low, then I would start considering lower prices. Until then, I'm perfectly fine doing nothing and letting price chop. Pamper 6-hour time frame. Not much to say yet. 4-hour time frame. Some bearish divergences are forming. However, as long as this range holds, there's no strong reason for bearish bias yet. Yes, price could form a lower high, but we first need to see what price does around. Trendline, local SR support. As of now, that level is not lost. 1-hour time frame. Momentum is currently near the lows, and in an uptrend, that's often exactly what we want to see. Why? Because lower time frame momentum resets while support holds. This allows higher time frames to stay bullish, while lower time frames cool off. Best case, 1H resets, 4H resets, trend holds, continuation higher. For now, this Monday setup is still developing. We've already seen bounce, some volume coming in. So from here, either we slowly reverse upward or chop around and form a bottom. Bearish scenario. If 1H momentum rises while price does nothing meaningful, then that would create bearish divergence, especially if 4H aligns with it. For now, though, they are not fully aligned. So, no clear weakness signal yet. Conclusion, higher timeframe momentum remains supportive. Lower timeframe structure is still intact. Current plan, wait, observe support, let setups form, trade level to level. For now, no major reason to aggressively short and no major reason to panic. Now let's mark out the new levels. Okay, so we now have the weekly open, the new averages, and the opening range for today. The weekly open is above, so that is the area to reclaim along with the high as well. For continuation, this level needs to be broken. For continuation from here, this range needs to hold this uptrend. An SFP into that low is completely fine, but for the bullish outcome, you either need price to hold here or SFP and reclaim my pass. That means whether you take a trade from here directly or wait for an SFP, the invalidation needs to be below, purely from an SR level perspective. If these levels get lost, then it opens the door for lower levels. And as you can see, there isn't much in between, so the next logical level would be lower. For me, the 75K low is interesting. The reason is simple. We have several EMA invalidations around 75K if you remember. So yes, a move back down into that level, especially if it aligns with yearly fib time, would absolutely interest me for a trade. The bigger level of interest is still below that, which means if this long gets stopped out, then the next long would likely be from the 2-day order block. The structure stops on the left SFP there, or even deviation into the OB. That remains a strong level of interest for me. Now, of course, locally we have a similar scenario. We have local trend, possible SFP low, average loss aligning with that level closely. So clearly, an SFP is possible not just visually, but also based on daily averages. But to be honest, I don't really want to trade here. I didn't last week, and I'm also currently not very interested in opening new trades here. I'd rather wait for yearly fib time. Now, this level can absolutely still play out, and if you have a plan or simply want to practice execution, then yes, you can trade this area. But as explained, the invalidation needs to be below the SR level with some room. Whether you enter directly here or wait for SFP, the invalidation concept remains the same. Direct entry, less confirmation, less chance of missing move. SFP entry, more confirmation, higher chance of missing move. Both approaches have pros and cons, but for both, if support is lost and flips resistance, then the trade idea is invalidated. So for now, I'll likely wait a bit longer. Either we get lower levels or I wait for higher levels. But I'm mainly waiting for yearly fib time. And if the 2-week candle forms an order block here, then yes, price could chop around for a few weeks. Not ideal, but we'll observe. The next few days are especially important. FOMC, new monthly open, yearly fib time. So we stay patient. Still, I hope this was helpful and that you now understand more or less what I'm looking at. Before I wrap it up, quick look at the Ethereum Rabbit box setup. It's still active, of course. We had a nice rise and now a drop. But my invalidation is around 900. So for me, this is not a meaningful drawdown yet. I'm simply holding this Ethereum trade for win or loss while managing size correctly. And I still think we should survive this challenge. So target remains 22646. And yes, I'll continue trading all setups together, just like the others. With that said, I wish you a nice day, and I'll see you in the next one.